Hi Nan.
Welcome to this tutorial. So today we are going to discuss about basics financial statement analysis. So we are just starting financial statement analysis. So this is our first session in financial statement analysis. As you know, the financial statement analysis is one of the most important part in the CMA USA examination, and also in your work life, it's really important. So in this tutorial, throughout this tutorial, I'm using a PDF material that's prepared by myself. So I'm giving the downloading link of this material in the description below. So you can download and use this material completely free. So financial statement, what is a financial statement? It's a formal record of financial activities or a financial position of a business. Who are the users of financial statement? The managers, the investors, creditors, and regulatory bodies to understand what is a company performance, what is happening inside the company, and to make various decisions. Like for the investors, they have to decide whether they have to invest or not invest. For the managers, they have to see the business performance, how it is going well or something going wrong. For the regulatory bodies, they need the financial report to see the tax income, make sure that their company is following the tax regulation rules and regulations. When you're looking into a broader concept, the financial statement, there are a lot of uses for financial statements. So these statements is basic financial record or formal record of financial activities and financial position or performance of a business. There are three primary financial statements are there. The first one is the income statement or the profit and loss account or the statement of operations. This statement report a company's revenue, expense, net profit or loss over a specific period of time. This period of time, this word here is very important because the income statement we are preparing for a period of time. For example, for a quarter or for a year or half an year, like this we are preparing the income statement. Overall, it shows the company's profitability. What it's showing, whether the company is profitable or company is in loss. What is the profitability of this business or this company? This is showing in the income statement. So when it's come to the balance sheet also called statement of financial position. This statement provides a snapshot of company's financial position or financial condition at a specific point of time. When we discuss the income statement, it's a period of time, but in the balance sheet, it's showing for a specific point of time. It details what belongs to the owners or what is company's equity, what is assets, how much the asset company have, how much the liabilities company have, how much equity company have. So the fundamental accounting equation, what we know is very familiar for us. Account assets is equal to liabilities plus equity. Is always balanced on this statement because we are showing all the assets in a side and respectively all the liabilities and equities in another side. So the asset is always equal to liabilities plus capital. So this is the second statement, that is balance sheet. The third statement, statement of cash flow. Statement of cash flow which track the movement of cash into and out of the business over a period of time. Cash inflow into business and also it's recording the cash outflow over a period of time. It helps explain the difference between net income and on the income statement and the actual cash a company has on hand, which is showing where was cash generated and where was it spent. It is showing the cash inflow and cash outflow from where company generated the cash and where the company spent the money. It is showing in the statement of cash flow. So these three are the primary financial statement of any business. We should have, so which is tracking the first one, the income statement is tracking the profit or loss, balance sheet tracking the financial position of a company, and the statement of cash flow which track the cash movement, cash in and cash out of a business during a period of time. A simple example you can see here, which is normally showing the revenues, how much the revenue, which means sales the company generated, how much the expense belongs to that revenue, and what is the net income. So as a simple equation, you can reduce all of your expenses from revenue to get your net income. So when it's come to a simple balance sheet, here it's showing the assets. The total asset value, it is 100,000. Also the total liabilities, which is 40,000, and also the owner's equity is 60,000. Here you can see the total asset is always matching with the total liabilities and equity. So when it's come to the statement of cash flow, you can see a statement of cash flow, simple statement of cash flow here. So the how much cash is generated from operating activities, which showing a positive cash inflow, which is a positive number. So how much cash is generated from investing activity? You can see a negative number here. That means there is no inflow from the investing activities, where it is only outflow is there. And also how much cash is generated from the financing activities, which is a positive number. So the net cash increase is 40,000, the sum of these three, which is a positive number. So these are a simple example or illustration to see how these statements are working. Now we will explore each of these financial statements and how to analyze them one by one. So first we will move into income statement. Income statement is a summary of a company's revenue and expense over a period of time. Its primary purpose is to show whether the company made a profit or loss. The result is called net income or net loss. The primary purpose of an income statement to see whether the company is made profit or loss, or the net income or net loss. So the income statement is structured in a way that allow us to see different level of profitability. So we will see the different heads or the elements of an income statement. The first one is revenue. Revenue means the sales. This is on the top level, so which is showing how much revenue or sales generated by a company during a period of time. The second one is cost of goods sold. Cost of goods sold means the direct cost which belongs to that revenue. If it is in a production, just assume if we are running a manufacturing company, that means the cost of production or services sold by the company. In the case of production, which include cost of material and direct labor. That means what is the direct cost related to this to generate this revenue? That is cost of goods sold. So the next part is gross profit. Gross profit is the difference between revenue and cost of goods sold. So how much revenue we generated, and we have to reduce the cost of goods sold from the revenue to get the gross profit. It represents the profit a company make from its core product or service before considering other expenses. Now the next part is operating expenses. The operating expenses include all the expenses incurred in running the business that not directly tied to the production, which includes selling a product or general administration expenses, sales and marketing expenses, marketing costs, salary, rent. All these belongs to operating expenses. So the next part is operating income. Operating income, we have to reduce all these operating expenses from the gross profit or GP to get the operating income. In this level, we are seeing the operating profit of the company, which also called EBIT, which means earning before interest and tax. The next part is other income and expenses. This include non-operating items like interest income or income from other investment or income from any other activities or expense belongs to any other activities. All these heads or accounts are showing in the other income and expense section. So the next one is income before taxes. That means your income, you have to reduce all these income and expenses, or you have to adjust all this income and other income and expenses from operating income to see income before taxes. The next part is taxes. So once you reduce that tax from the EBT, earning before tax, you will get the net profit or net income, which is the bottom line of any income statement. That means with the net income, we have to adjust all these things like cost of goods sold, operating expenses, other income and expenses, tax, everything we have to reduce and adjust to get the income statement, to calculate the net income, which is also called referred as the bottom line of the income statement. So here you can see an example for income statement. So here a revenue is 150,000. So for the first thing, you have to reduce the cost of goods sold from the revenue. So you can get the gross profit, that is 90,000 in this case. So after that, you will come to the operating expense part, that is selling, general and administration expenses, that is 30,000. If you reduce these operating expenses from the gross profit, you will get the operating income. After the operating income, you have to reduce the interest or any other expenses. Once you reduce all these expenses, you will get the EBT, that is earning before tax. From that, you have to reduce your tax expense to see your net income. So the net income means that net profit available to the shareholders. So from the net income only, we are distributing the profit to its shareholders. So this is about the income statement. Now we will move into the next part, that is balance sheet. A balance sheet is like a photograph of a company's financial health in a single point of time. It provides a detailed breakdown of a company's financial resources like assets, its liabilities, and its ownership or its equity. The balance sheet is based on a fundamental accounting equation which is called asset is equal to liabilities plus equity. This equation must remain always balanced. This means everything company owns must be funded by either debt or equity, which means if a company have an asset, which means it should be funded by either debt or equity. We'll go to the component of balance sheet. The first one is assets. Assets mean resources owned by the company that have future economic values. There are mainly two types of asset, current asset and non-current asset. Current asset mean asset expected to be converted into cash or used up within 1 year. Current asset include cash, account receivables, and inventory. Non-current asset mean asset that are not expected to be converted into cash within 1 year, which include property, plant and equipment, intangible asset like patent, copyright, etc. So asset, there are two classifications are there, current asset and non-current assets. So the other section in balance sheet is liabilities. Liabilities is the obligation to other parties that company owes. There are two types of liabilities. One is current liabilities. Current liability means which obligation due within 1 year. Example include accounts payable, short-term loan, and accrued expenses. When it comes to non-current liabilities or long-term liabilities, which are the obligation not due within 1 year. Example include long-term debts and bonds payable. These are the liabilities which is our obligation which will not due within 1 year. This part of the balance sheet is equity. This is the resident interest in the asset after deducting the liabilities. This is the proportion of the company that belongs to the owners. There are some categories of equities are there like common stock. Common stock means the amount of money invested in the company by shareholders. In the retained earnings, the another category is retained earnings. The cumulative total of all the total profit, all the company's profit that have been kept in the business rather than paid out as dividend to shareholders. If there is any profit that generated during the previous period, which belongs to the equity shareholders, if the profit is not paid, which is called a retained earnings, this retained earnings also a part of equity. We'll go see an example for a balance sheet. Here you can see the current asset. This is the asset side. Here you can see the current assets like cash, account receivable, inventory. So you can see the total current asset. The non-current asset like equipment, vehicle. So you can see the total non-current asset. The total asset value is 140,000. So you can see the liabilities and equity part here. The current liabilities. One is account payable. In the non-current liability, bank loan payable. So the total liability is 40,000 in this case. When it comes to equity, there are common stock and retained earnings. So the total liabilities and equities 100,000 plus 40,000. You can see the total asset is always matching with the total liabilities and equity. Statement of cash flow is considered the most important of the three financial statements for understanding company's true liquidity. While the income statements show the company's profitability, which include non-cash items like depreciation, cash flow statement provide a clear picture of how cash is being generated and used. This is bridge the between income statement and balance sheet, explaining the changes in the company's cash balance over a period of from one period to next. The statement of cash flow divided into three main sections. That is, the first one is cash flow from operating activities. This section reports the cash generated from a company's core business operations. That is cash flow from operating activities. So the next section is cash flow from investing activities. This section shows the cash used for or generated from a company's long-term investment. That means from investing activities, which include purchase or sale of property, plant and equipment, as well as investment in other companies. It is all showing in the cash flow from investing activities. Now the cash flow from financing activities. This section report the cash used and funded to the company. It includes cash raised from issuing debt or stock, as well as cash paid back to investors through loan repayment, dividend or stock repurchase. So which is showing the cash inflow and cash outflow related to financing of the business. This is cash flow from financing activities. So here you can see an example for statement of cash flow. So you can see net cash flow from operating activities, net cash from investing activities, net cash from financing activities. So if you see the net cash flow from operating activities, what you did here, you started from the net income. There you adjusted the non-cash item like depreciation. You have to add depreciation to net income to see your real cash flow. After that, you have to adjust the changes in your net working capital. That means increase in account receivable. That means you have invested another 10,000 in account receivable. Increase in supplies inventory. That means you have invested another 5,000 in inventory. Increase in account payable. That means you have a positive cash flow from the accounts payable. So that means in this case, the net cash flow from operating activities is 50,000 plus 5,000 minus 10,000 minus 5,000 plus 5,000. That means 45,000. So when it's come to investing activities, there is only one activity, that is a purchase of an equipment, which is on 15,000. So which is you can directly show it's as cash outflow. So when it's come to financing activities, there are two activities: proceed from bank loan, investment by owners. These are positive cash flows. So how you calculate the net cash flow? You have to add up all these things, which mean the 45,000. This is a minus number, so you have to reduce it. Minus 15,000 plus 45,000. That means 75,000. So the net increase in cash during this period is 75,000. So in this way, you can prepare the statement of cash flow. Now we'll move into the financial statement analysis. The first one is vertical analysis. Vertical analysis. When you want to compare two companies, their differing sizes can make that comparison difficult. I mean, if you are trying to compare two companies which have a different level of business activities, which can be difficult if you are comparing directly from the financial statement. A large company's net income will almost always be higher than smaller companies, even if the small company is more efficient, right? In vertical analysis, also common size financial statement analysis solve this problem by normalizing all the data. How it works? For the income statement, every line is expressed as a percentage of a total revenue or percentage of net sales. This allows you to see how much of each dollar of sales goes to cost of goods sold, operating expenses, and ultimately net income. But in the balance sheet, every item line expressed as a percentage of total assets. This show the composition of company's asset, how they are funded by liabilities and equity. We'll go through an example. Imagine if you want to compare two companies, Retail Co and Mega Co, using their income statement. So you can see their original income statement. In this case, the net sales is much higher in Mega Corp compared to Retail Corp. So, because this is a smaller company, this is a bigger company. So if you want compare the two businesses which have different level of operation or different size, where you can use vertical analysis. So you can see this income statement here, the net sale of both companies, cost of goods sold of both companies, GP belongs to both companies, operating expenses belongs to this company, two companies, net income belongs to these two companies. If you look into the net income, this Mega Corp's net income is very higher than the Retail Co. But we can not directly say which company is performing better because these two companies are operating with a different level of activities or in a different size. So in this case, we can use vertical analysis or common size income statement to see the performance. Now you can see the performance here. The net income or net sales you considered has 100%. When it comes to cost of goods sold in Retail Co, in the first company it is 60% of the net sales. But in the second company, it is 50% of net sales. That means this company is doing better. The same time, the GP, this company is 40% and this company is 50%. So this is doing better. The operating expenses, if you are looking into operating expenses, here it is 25% of net sales. Here it is only 20% of net sales. So that means this company is doing better. When you're looking into net income also, this company is 15% and this company is 30%. Here you can easily say the profitability is higher in Mega Co because which have 30% in net profit margin. But for the first company, for this company Retail Co, which have only 15% net income. So in this analysis, what we can say, Mega Corp is significantly more efficient than Retail Corp. It spends less of its sales on cost of goods sold and operating expenses. This results in much higher profit margin with Mega Corp retaining 30 cents every dollar sales as a profit compared to only 15 cents for Retail Co. So this is analysis what we can get from this vertical statement analysis. So the next analysis, horizontal analysis. While vertical analysis is great for comparing different companies, horizontal analysis, also known as trend analysis or common base year analysis, is used to evaluate a single company's performance over a period of time. Which is used to analyze a single company, similar company's performance, a same company performance over a period of time. This method highlights changes in financial statement line item from one year to next and help identify significant trend, both positive and negative. In horizontal analysis, you select a base year and set its value to 100%. Then you express the value of all subsequent year as a percentage of that base year. This allows you easily visualize growth or decline in different areas of the business. You can also calculate the year over year growth rate to see the rate of change between two periods. So here we can see an example for an horizontal analysis. So this is a 3-year income statement. You can see the net sales, cost of goods sold, gross profit, operating expenses, and net income for 1, 2, 3. Total 3 years. So in this example, you can consider year 1 as your base year. So you have to set 100%. You have to fix your first year or year 1 as base year. So you have to make all these values as 100%. From that 100%, you can compare or you can generate the subsequent value of proportion of year 2 and year 3. So if you are looking to the net sales, it's grown 120% compared to base year. And in the third year, it's grown 150% compared to base year. So in this case, you can analyze that net sales grow constantly to 150% of the base year by year 3. That means when you're comparing year 1 to year 3, the sales has grown to 150%. So when it's come to GP also, it's shown that it is grown to 163%. This indicates that the company is either increasing its price or become more efficient at managing production costs. That means here you can see the sales increased only 150%, but the gross profit is increased to 163%. That means more than sales increased, which means either company increase its selling price or becoming more efficient at managing its production cost. If you are looking to operating expenses, also grown significantly into 160% when compared to base year. Also, if you are looking into net income, which is grown into 167% compared to net income, which means this business is managing its expenses in an effective way or it's selling its product on a better price compared to year 1. So this analysis shows a healthy and growing company with a strong revenue and profit trend. So in this discussion, we have discussed what is the financial statement, what are the key financial statement, and the two major financial statement analysis like horizontal analysis and vertical analysis. So if you have any doubt or you need any additional clarification on this session, please comment on the comment section. Thank you for watching this video.